Introduction to geopolitics. Now, geopolitics is obviously a very, very vast field. And as far as the CFA curriculum is concerned, we are, of course, more focused on the investment process. So, we will be talking about geopolitical risk in the context of the investment process and also in relation to the next learning module, which is international trade. So, before we get into this learning module, what I want to do is help you develop a context of this reading so that instead of getting lost in the huge world of geopolitical analysis, which is, of course, something that we cannot get into entirely in just one learning module, what I want you to do is focus on how it impacts the investment process, right? And is international trade something that is good from an investment perspective? So, the first thing that I want you to understand is that when we talk about cooperation, from an investment process perspective, cooperation is a good thing because what we see is that it results in benefits for both parties, because if both parties agree on maximizing whatever is most efficient for them to do. Let me give you an example. Let's say if Google in the US is making Android software and China is making Huawei phones and Xiaomi and Redmi phones. And if this combination works well, that the people of the world get phones which are good quality and the software is good, the hardware is good, and both countries make profits, right? Both companies in both countries make profits. So overall, it's a good situation for the investors. But then if they start to distrust each other, and which is what we saw in the past few years, that the US felt that, oh, we should make the chips ourselves. Why depend on the Chinese? And the Chinese felt that, oh, we should make the software ourselves. Why should we depend on the American companies or the British companies that do the chip design? So this obviously then brings nationalist interests above economic interests, which is obviously not good for the investors, because investors are obviously looking for the best economic result. And that requires that type of cooperation. So this type of cooperation requires trust. And that is what you will see in the next learning module, that when we talk about international trade, we want international trade to increase because it brings efficiency, and at the end of the day, it brings the best investment returns. But it's easier said than done because governments have their own national agendas. And the problem with long-term benefits is that political governments probably come into power for maybe 5 years, right? 4 years, depending on whatever is the cycle in any given country. And they need to show results within that cycle so that they get re-elected. So when you talk about initiatives which are going to make things work and make things more efficient in the long run, it's not easy for the politicians to actually do that because they need to show results in the shorter term, and they also need to make people happy who are their vote bank, which is not necessarily going to be done by increasing cooperation. So we have to understand and appreciate all of these factors, and then from an investment process, we need to understand that whenever we calculate the value of an investment, it is equal to the present value of future cash flows, right? And future cash flows are discounted based on, so the way the present value is calculated is that you take the future cash flows, right? And you discount them back by a certain discount rate. So this discount rate could be the risk-free rate if your future cash flows are 100% certain. But if your future cash flows are not certain, there is an uncertainty associated with them. So if they are coming from not US Treasury bills, but from, let's say, Google or Apple cash flows, then they would be slightly more uncertain, but still not that uncertain. But if you are expecting these future cash flows coming in from an international investment, and then depending on all the geopolitical moving parts, then you would be more uncertain about these cash flows. So the higher the uncertainty, the higher this discount rate you would use, and therefore the lower the present value of those cash flows would be, and the lower the value of that investment for you. So how we incorporate this entire discussion in the investment process is that the value that we calculate of the investment will be the discounted value of its future cash flows, and that obviously is discounted at an interest rate or a discount rate which incorporates all this country risk and currency risk. So this is the entire context of this reading. Now let's get into it and discuss what are all the different moving parts and how can we assess the actors if they are moving in the right direction or the wrong direction, right? So we want to basically see these signposts that give us signals that if something is going from green to red, right? And that is what we're going to learn in this learning module. Right. So let's get started with the definition of geopolitics. It's basically how geography impacts politics, right? So hence the word geopolitics, because the geo is for geography and politics is for how people elect their leaders and then they take decisions for and on behalf of those people to prioritize the interests of those people, right? And we as analysts, we study what these actors are doing, right? State actors or non-state actors, they're both, you can have companies taking decisions or you can have government officials taking decisions. And what we as analysts need to do is study what direction are they headed in. Is that a direction which is good for us as a investment return possibility, or is it bad for us? And accordingly, do we need to adjust the discount rate that we are using to calculate the present value of their future cash flows, right? So let us discuss the risk that all of this geopolitics results in a risk for us that could be due to some changes in policy, or maybe there is a natural disaster. For example, the earthquake in Turkey. Naturally, if you have an investment stake in Turkey, you are going to be impacted by the earthquake. Or maybe there is some sort of a terrorist act or a war. So that's why we as analysts need to study these risks, because it can have a significant impact on our investment. And we need to have a framework to be able to do that, right? How to measure that risk, track that risk, and react to it. So first of all, the actors can be state and non-state, right? So state actors are government officials, such as the president of a country or the parliament altogether or the prime minister of a country. And then your non-state actors are leading companies, multinational companies, people like Tim Cook, right? Elon Musk, Jeff Bezos. So, and it's not necessarily business leaders, it could be cultural icons as well that are opinion leaders, right? So we need to study the behavior of state as well as non-state actors. And what do we need to study it with? So let's say if you have one simple continuum where on one extreme we have competitive, right? And on the other extreme we have cooperative. And I know Germany once was very competitive, but now it is a cooperative country. Japan, I would say, is now also or Singapore, I think, is a very nice example. Singapore. So we would have these type of countries on the extreme part of the cooperation. And competitive, I would say North Korea. So just to help you understand that when we say competitive, obviously Germany is a competitive country, right? I mean, they have competitive products, the quality is good, the price is as per the quality. But when we say competitive in the sense of geopolitics, what we mean is that they will compromise or they would prioritize their personal interests or the interests of their country over cooperating with others. Whereas cooperative countries will balance between both, that is the interest that they have for themselves and the interest that others have. And why do you think some countries will be more open to cooperation? Is because maybe they need to be, right? So Germany obviously tried being competitive first. It didn't work out in the first two world wars, and now they are being cooperative, and it's working out very well for them. Singapore, for example, has very limited resources internally, so it's a very small country. So cooperation makes a lot of sense for them. And we will discuss all these factors, that why countries are more cooperative than others and how does that impact them. So cooperation is obviously countries working together for similar goals, right? And that could be strategic goals or military concerns or economic influence or cultural preferences. You know, you've got the Eurozone, which is culturally similar to each other, right? And how do you go about doing that? So you could have, let's say, similar rules, standardization of the product qualities, right? And then you could even extend that to the level of having a single currency, which you see in Europe. So of course that is probably one of the best examples we have of cooperation. And then you have non-cooperative countries like North Korea. So a cooperative country engages and reciprocates in rule standardization. So they will make products of a certain quality which adhere to a certain standard. You'll have tariff harmonization, which means the import duties, the export duties, tariffs, taxes, everything is going to be harmonized, generalized for everybody. So it gives a level playing field, right? You can have international agreements on trade which reduce the taxes being imposed by either party, and this is something you will understand more in the next reading, in the next learning module on international trade, that how countries can discourage or encourage international trade, right? And why they would like to discourage and why they would like to encourage, and how does that impact the economies. So what I would recommend is that watching the next learning module videos as well, and then maybe watching this one again, because they do have a lot of interlinkage between them. Some countries, of course, have a huge immigrational relationship with others, and then they need to respect each other accordingly because they have a stake in each other, right? You can have similar regulation, free flow of information, as well as technology. Whereas your non-cooperative countries are inconsistent, right? And they have a restriction of not only goods, but people, services, money. There could be physical retaliation involved and a certain amount of control, especially on technology as well. Right? So, again, coming to the reasons why a country may want to cooperate or not. And of course, this is defined by the country's national interest, but then what are the various factors inside that? So, first of all, is national security, right? And think of South Korea. South Korea is being supported by the US, or think of Taiwan. Taiwan is being supported by the US, or think of Japan, or even the European countries now with your NATO alliance with the US. So just to have a national security coming in, and with respect to the protection of its country and its economy and its institutions from external threats, this could be a motivation for cooperation. Now, Japan would like to cooperate with the US, South Korea would like to cooperate with the US, Taiwan would like to cooperate with the US, Germany, France would like to cooperate with the United States because they would like to benefit from the national security and protection that the US can help them achieve, right? Think of a landlocked country like Switzerland, which relies heavily on its neighbors, right? If it didn't have good relationships with its neighbors, then naturally it would not be in a very good position. So such a country would definitely be open to cooperation, right? Another one like Singapore is situated in such a fantastic location that, I mean, if it doesn't cooperate, then it's not really going to be able to leverage its position, right? And the second thing is economic interest. So if, for example, there is a company in a country which can only benefit if it's going to export, right? Or if it needs certain key raw materials for import. And if that is the case, then of course you have to open up and increase the cooperation to be able to benefit, right? So you need essential resources, and then you want to produce products of a certain quality or standard so that the world buys them back from you. And think of countries like Japan that need, or China that need fossil fuels, right? So they buy them from the Middle East. So China buys oil from the Middle Eastern countries like Saudi Arabia, and then they produce a lot of goods and then they sell them back to the Middle Eastern countries. So if the Saudi and the Chinese didn't cooperate, right, then both parties would lose, because then how would the Saudis sell their oil to them, and then how would the Chinese then sell the products back to the Saudi? So economic interest also is a motivation for cooperation, and that really depends on what is the resource that you as a country have. So China doesn't have oil, no oil, right? And Saudi, let's say, doesn't have the labor that the Chinese people offer. So, well, I wouldn't say no labor, but I would say less labor, right, compared to the Chinese. So what is a strategic relationship is that Saudi provides the oil, and then Chinese convert that oil into products and send them back to the Saudi. But then obviously there has to be a certain standard involved, right? So that's how resource endowment and standardization are linked. Soft power is then something that can be used to promote this cooperation, and we'll talk about that. Right. So first of all, with the resource endowment, some countries have more resources such as food, water. Some have less. There could be geographical advantages somewhere, right? Climate advantages. There could be things like oil. So whereas countries like the US are self-sufficient, but then you have other examples like Japan, which is heavily reliant on some key factors like fossil fuels for import. And I just gave the example of China, but Japan is no different. Even they import their oil. US now, of course, has not only become self-sufficient in fossil fuels, they are actually exporting it now. So these are the factors that create the power dynamics and the terms, and they influence the terms for engagement between the states. Standardization, of course, is required if you want to have cooperation, because, I mean, you're not going to buy products from another country if they are not providing it to the level of quality that you want. And it's not just about quality, it's about being able to work together, right? There has to be a certain process. And I'll give you an example of this related to the financial industry shortly. But it's a very important thing that you agree to follow a certain process which both parties can relate to, right? And that standardization can be broken up into three, which is number one, the regulation, number two, the process, and number three, the operations. And let's understand this with an example that is there from the curriculum. And I think it's a very nice example, but this is specific for banking. right? So now, before we get into the example, I want you to develop a sort of a theory in your mind about what are we talking about. Why does banking need to have a standard for international trade? So think of like one party importing from another party. So let's say a Chinese company is buying oil from a Saudi Arabian exporter. So there will be something called a letter of credit, right? Which means the Saudi will say, "Hey, uh, please send advance payment. Otherwise, I don't want to pay." The Chinese will say, "No, please send the oil first. Then we will send you the payment." And then the banks from both sides come in, and the Saudi bank tells the Chinese bank that, "Do you know the Chinese party over there?" And the Chinese bank says yes. And then the Saudi bank says, "Okay, I know the Saudi party over here. So let's us banks exchange something called a letter of credit that you, the Chinese bank, can vouch for the credibility of the Chinese party. So we will tell the Saudi to export that oil, and once you receive the oil, you can release their payment." So there is definitely a role that is played by the banks for uh, doing the trading, right? So naturally the supply chain will get involved to verify that has the oil reached or not. The payment will have to be done, and that is where the SWIFT comes in. So we're going to look at this entire flow from the perspective of regulation, then process, and then operations. So first, with respect to regulation, we are so grateful that we have a solution now for the regulation of banks all over the world, which is the Basel Committee on Banking Supervision. And I think this is really, really great. Unfortunately, we still don't have one for insurance, right? We're still working towards that. Another example would be corporate governance. We don't have a standard code of corporate governance for the whole world. But let's be thankful for what we do have, and that is a standard regulation for the entire world for the banking sector, which is your uh, Basel and Basel 3 currently, right? And where did it all start from? So there was this bank in Germany which had some trades going on with other banks from the UK and the US, and the German bank actually had more losses than they had money in their capital. And then when it went bankrupt, they couldn't pay the other banks. So that made us all realize that, hey, we as international banks have an exposure to each other, right? And if we don't have a common regulation, then we're not going to be able to protect our interest if either of the banks fail. So we all need to take care of each other to be able to take care of ourselves. So that's where the BCBS was formed, and of course now we have a very nice regulation for the entire world. But then that's not enough, because you need to have a process for you to deal with each other, right? How to send money across each other, across borders, and that's where SWIFT comes in. So it then makes the process more standardized, right, through your SWIFT messages, and facilitates global payments across 200 countries, 11,000 institutions. And then finally, you have your operational synchronization in terms of your trade finance, right? Containerization, you've got so many different terms: FOB, CNF, CIF, right? And I don't want to get into the world of trade finance over here with you, but it is definitely something that reduces the time and cost of shipping goods. So, very nice example in the curriculum here. And it really helps us understand how we can have standardization across regulation and the processes and the operational synchronization. Right. Next, we will get into cultural considerations and soft power. But I think let's take a break here. And I would like you to digest what we have studied so far. Maybe even have a look at the curriculum if you want, because this is an extremely interesting area. And before we jump into cultural considerations and soft power, I want you to understand the discussion that we have had on standardization with respect to regulation, process, and operations.